Hey there, Am I Rich? And today, do I have a company I sense is very good. It is under the ticker symbol 6861 on the Tokyo Stock Exchange. That company is Keyence. I think it's also under maybe the symbol KYCCF in Canada or the US. It might vary a little bit, but the company is Keyence. And what do they do? Well, they produce sensors. So they're usually kind of lumped in with robotics, and they are connected with that. What they do is these sensors that they make, they basically put those in automation and robotics and other specialized processes. And then they have a really good sales force that does kind of a consulting job to help clients get all the right sensors that they need for their task or job that they want. So that is basically what they do. This company is really at the forefront of sensor technology, and that's one reason why it's been put into like a robotics. If you're looking at mutual funds or ETFs that are based on robotics, those usually have Keyence in them. Now, Keyence, right now I think the stock price is at 67,730 yen. That gives it a price to earnings ratio of about 36, which is pretty high, and a forward PE ratio of 30.6. So because it's a lower forward PE ratio, that's forecasting growth. And the price to book ratio is 7.3, so not very cheap, but there might be a reason. The dividend is less than 0.1%, or maybe about 0.1%. It's very low, kind of negligible. And then if you look at the 5-year growth rate for this company, it's been growing at about 19.5% every year for the last 5 years. So it's pretty good growth. As far as this company, they have no real debt issues. I mean, they have lots and lots of cash on hand relative to their debts. Their cash flow is much higher than even their current liabilities in the year. And so why do I look at this stock and think it's an interesting stock? Well, one reason is the stock price has dropped in 2018 in December, and because of that I thought it was at a pretty good price. It has since come up, but I still think it's at a reasonable price, that this stock could be a bargain, even though it's a very high PE ratio. And the reason is because of its growth vectors. Like, the main growth vector is that it's involved with automation and robotics. And so if you're at the forefront of automation and robotics, then companies that need these products or are trying to improve efficiencies, they're going to keep trying to get these products. And yeah, I just see that more and more in the future. That's just more and more likely to happen. So Keyence is really well positioned for this. They seem to be doing quite well financially, so they can probably handle a recession. And yeah, they just keep growing at a really fast rate. So I don't know if that growth rate will continue, but generally the appreciation of the stock, it's gone up dramatically. I think it's more than like tripled maybe in the last 5 years or so. So very, very interesting stock. Now, the downside of this company is that they don't really talk to analysts that much. And so they don't explain like how they research, or they don't, or their research budgets, I should say. And then so it's kind of ambiguous at how they can keep up this growth rate. But because they are at the forefront and they've been doing it for several years, it does seem like it's going to continue. Another issue is they could have competition come in. They already have competition, but other robot or sensor companies, if they can get a same level of technology, then you could see this company kind of have issues. But right now that isn't the case, so it has a bit of a moat. And yeah, kind of what I'm seeing. Like, I'm not really seeing anything obvious for a downside of this company. Now, its price right now, I think, so like, you do look at the price and think, oh, it's overvalued. But because it's in the robotics category, most robotic companies are quite a bit overvalued. And this one, it's also like considered to be one of the top of its peers. So it has been probably priced like maybe triple what it should be. But it's been priced like that for a long time, and it's been growing very well every year. So because of its growth rate, because of its kind of typical, like what people are willing to pay for it, I do see this company as probably a good price right now. That said, I guess that could be also a downside that, you know, if for some reason it didn't have its edge in sensors and it wasn't able to continue its profit margins, then I suppose you could see this company drop, probably not like to a third of what it is, but I suppose you could see, you know, drop maybe like half or something. So that's definitely a big risk, and so that's something I would probably hesitate to invest in if it has that big of a risk to it. But that said, I do think its stock price is probably reasonable, and its track record suggests that it's very unlikely that that will fall, that the stock price will fall that far. And they do have, I mean, their finances are so robust. It's, I mean, unless they're cooking the books, it seems like they're definitely on a track of stability. So yeah, I kind of think this is a buy right now. I don't know if it will go up necessarily that fast in the next 3 to 6 months, but after that I do see it to continue to grow. So yeah, I'd love to know what you guys think. Do you think this is definitely a stock of the future? I mean, I definitely see automation just continuing on a good path, and a company like Keyence is really right in the thick of it. So let me know what you think in the comments below. Otherwise, thanks for watching, and we'll see you next video.